Gerrish now from Shaw and Partners, who joins us live. James, good morning to you. Let's get straight into it. Transurban, obviously in focus today, out with its numbers. What did you make of the result first up? And there's a lot of other things to talk about when it comes to Transurban. But first up, in your view, was it a slight miss?
Yeah, it looked like a miss on the EBITDA line, but it was a beat in terms of the profit line. And I think one of the important things for Transurban today will be their dividend guidance if they win the WestConnex project. So they've said that dividend guidance is 59 cents per share, up from 56 in the prior year. Importantly, they've said that that will be maintained even if they win the WestConnex project. So I think the market was concerned that, with increased, obviously, expenditure, etc., going in that WestConnex project, they wouldn't be able to maintain the dividend. So that's probably going to be taken as a positive in terms of Transurban going forward. But again, it is a slight miss on the EBITDA line. The market was at 1.72 billion. They reported 1.67 billion. As I said, it was a slight beat on the profit line. Yeah.
I'm imagining, though, today, as you mentioned, WestConnex, a lot of questions on the call with management will be around WestConnex and sort of implications of WestConnex if it does go through, because there's still a question mark, big question mark around this.
Yeah, there is, and whether they go out there and raise capital and preempting they're going to win the bid, or if they don't, indeed. So, they've got a massive amount of requirements for capital in the years ahead, and WestConnex is a massive project. There's no two ways about that. It obviously will drive earnings in future years, which is a positive. And I think it is an overall positive for that business. They need to continue to build these projects. They need to continue to be involved in these projects to drive future earnings. But I think from a near-term perspective, the market was concerned that they would cut their dividend based on that project. They've come out today and said they wouldn't.
All right, well, watching that one anyway throughout the session today, but there's a bunch more to get through, including Eclipse Group, which overnight, bit of a downgrade in profit growth guidance for this one. What are you watching for Eclipse today then? I mean, do you expect this one to take a pretty big hit?
Yeah, it could well do. I mean, they've come out and said that they were previously guiding a 27 to 30% growth in profit. They've come out and said it'll be closer to 13, somewhere between 13% and 17%. To give you an idea of that, they're now guiding to 77 to 80 million in terms of profit. The market was sitting around 87 million in terms of profit. So, look, it's about, it's what, 10% or a bit more percent of a downgrade in terms of the profit line. They're saying the Grays Online business is probably at cycle lows. So there's been, low delinquencies. There's been a lot of infrastructure projects around Australia where equipment has been required for longer. So that's obviously reducing the volumes going through that business. I mean, I guess you can look at it two ways. Eclipse is not an expensive business at the moment. It trades on about 10 times earnings. So those earnings have been cut, so it's going to be trading around 12 times. It's still an industrial growing earnings. It's just going to grow earnings at a slower clip. So, look, it's not an expensive growth stock. It's a cheap stock, cheap industrial that is growing earnings. So, it'll be interesting to see how the market takes it today. But it trades on pretty low volume, so it could get knocked around today. I
mean, given Grays, the e-commerce business there, is to blame technically for the downgrade, do you expect that to turn around? I mean, is it in a bit of a trough there, do you think?
Yeah, it looks like cyclical factors at the moment. So they've increased market share overall in that business, but they've just got the market's been smaller in the short term, and that's obviously been hitting their earnings coming out of it. So it is a naturally it's a business that actually does better in tougher economic times. So when delinquencies are higher, obviously there's more equipment being seized by banks and being sold on Grays Online, so they do well in that regard. So it is a bit of a defensive from an economic perspective. It's a bit of a defensive style business. So things have been going well. Delinquencies are low, etc. Utilisation, infrastructure, etc. for some of that heavy machinery that usually goes through Grays has been really high. So look, I think it does look, in my perspective, it looks like cyclical factors rather than anything structurally wrong with that business.
All right, can we talk the other one that we're watching today, IWF? So we've seen Transurban and IWF both out with numbers in the last sort of hour or so. IWF looking pretty much in line. I mean, revenue was up, 1%, 919.1 million. We did see profit from ordinary activities at 88.3 million. That was down 24%. All in all, how does this rate versus your expectations?
Yeah, I think that number must have been for the half. So on the full year results,
Yep.
EBITDA was 263. The market was sitting at 271.
Yep.
So it's about a 3%. Excuse me. It's about a 3% miss in terms of the EBITDA line, and the profit came in at 191. The market was at 194.8. So
Okay.
a slight miss in terms of profit. The dividends being maintained for the at 27 cents per share. So that was in line with expectations. But to me, it looks like a slight miss. The guidance and this is a really complex business at the moment, obviously.
Yep.
Taking on ANZ's wealth business, the Royal Commission, etc. So there's a lot of swings and roundabouts, and guidance is hard to get out of this business at this point in time.
It is hard, and at the moment, I mean, they've been slammed by the Royal Commission, just in the last couple of weeks, by Hayne, of course, and had a lot of sort of tension around that. We know that they're facing the Royal Commission. We know CBA is also facing the Royal Commission, the banks, NAB as well, and CBA's out with reports this week on Wednesday. NAB's out on Friday with a quarterly trading update. How does this play out for them and the share prices of the banks and the financials more broadly, the IWFs and other, Magellan's out this week as well. There's a lot of financials out, Magellan less, related to all this, but in terms of what you're watching, how does this play out for that sector?
Well, IWF's a bit of a different beast because they made an acquisition just before all this played out. So, they've bought pretty much at the top of the market. They could probably, if they were making the same acquisition today, it would be at a lot cheaper, significantly cheaper price. So the other thing is, one of the things that have come out of the Royal Commission, and we've heard a number of financial companies talk about it, is how systems talk to each other and how, things have fallen through the cracks. So they've been charging people when they shouldn't have, etc. And a lot of the blame is put around the systems that they rolled out. They obviously deal with a lot of customers, and these systems can have issues. But if you think about IWF and they're integrating various systems from ANZ, various systems internally, that's going to be a pretty big task for them to do in an environment where there's a lot more scrutiny, thanks to the Royal Commission. So, look, I think it's a really complex time in that. We've seen platform fees on the way down. So not only are they getting hit from greater compliance costs, they're also getting hit from weaker revenue or weaker earnings, given that we're seeing a reduction in fees. So, look, it's pretty complex. To me, IOF, I'm not in that stock. I think there's very little reason to be in that stock. There's two cases. You can say that it's growing earnings pretty strongly based on the ANZ acquisition, but I think there's too much complexity and risk in that business at the moment.
So what are you watching broadly for reporting season? We're only a few companies in. Hard to make any... I mean, confession season was broadly positive, according to most analysts that you speak to. What's your take on reporting season to come? The next few weeks, obviously, the big ones.
Yeah, I think one of the trends we've seen so far is fund managers seem to be sitting on the sidelines waiting for the report to happen and then acting thereafter. So that means that weak reports are being sold into on the day of the report, but also ongoing for days after. We saw it from Rio Tinto last week. That stock's going to be down again today, so that's come off reasonably hard. We've seen it on better reports, so reports that have been good on the day have seen sustained buying thereafter. Seek, for instance, was a weak report yesterday. So my concern at the moment is around these higher valued growth stocks that are struggling to deliver growth. They're priced so highly. Seek, for instance, was an example yesterday. So, look, I think the reporting season will be okay. Earnings growth of about 8% year on year is reasonable. It's going to be largely driven by the miners, etc. But I don't think it's going to be enough to push this market out of its range that it's been trading in for a while now, Ingrid.
Lots to watch, though, indeed, over the next few weeks. We'll be watching very closely a bunch of reports to come out over coming days, and, of course, this week in particular. James Gerrish, we'll leave it there with you, but appreciate your time and analysis this morning on those reports that have dropped so far. Thank you.
Thanks, Ingrid.